out, they've owned this real estate, they must have a point of view. I don't know what that is, and it needs to be articulated. From there, the second step would be to ask the board members or management to prepare some analysis of the real estate. The analysis of the real estate that you get in the 10K is an SEC requirement. It's not what real estate people look at, and it's probably not what retailers look at. From there, you make it a determination as to whether or not you want to go forward in one direction or another. So I think the first thing, the most important thing, is to hear how they see the issue themselves.
Question up top? And actually, you can put the questions from the web on. We're going to try to alternate and address some web questions as well.
Yeah. Is there anything about the nature of the real estate transaction that might be inconsistent with how your real estate needs might change in terms of doing more grocery superstores and things like that?
No. I mean, the beauty of what we proposed, it has really no or just de minimis operating impact on the company. Today Target leases land in, or land only, I think, in 10% of their locations. And I think they always try to buy the land because it's, if they've been able to do it historically. The benefit of a land lease, particularly one that you set up inside your company before you spin it out to shareholders, so the Target can write whatever lease that it wants, is because you have so much security in the form of a building, and Target as the underlying credit. You can give the landlord enormous flexibility in terms of making modifications to a building. So if you want to expand a location to accommodate a superstore, you can do that. If you want to, completely redo a location, you can do that. Traditional sale-leaseback transactions where there's a land and building, the landlord, obviously you're starting to mess with his asset. The land is not going to be any worse off if you build a bigger building on it. So certainly the ground lessor is not going to complain about it. But very often if you own a land and building and the tenant wants to make some modifications, it's kind of like when you have an apartment and you got to call your landlord before, ripping out the kitchen and putting something in because, he or she is concerned about what the rentability of it will be once you're gone. We really address that problem in our transaction. But that's a gating issue. That doesn't solve all the potential issues. But I think with the benefit of Michael Ashner's expertise, with Goldman Sachs or another bank being given the full assignment, as opposed to the very narrow, take a look at Pershing's deal and either accept or reject, you're not going to get to the right answer. Take a look at Pershing's deal, see what good ideas they have, see what's bad about it. How do we modify it? How can we create a lot of value here? It seems like an anomaly. I mean, this stock was at $28 a share when we launched the proxy contest. Easy math, at $28 a share, the company had, I think, something like a $40 billion total enterprise value, including credit card receivables, including real estate, including a retailer. Well, if you think the receivables are worth something close to par, let's say $7 billion, and you think the real estate is worth, something close to $40 billion, you were paying a negative number to buy Target's retail operation. That seems wrong to me. It's still an anomaly at today's stock price, so I think it's worth a look. That's how we think about it. From the web, credit rating. Has your view on Target's credit rating changed from your most recent public commentary that any transaction you propose should be credit rating neutral? Yes. I'm of the view that having strong investment grade ratings is a key strategic asset for Target, and that I wouldn't push the company to do something that I didn't think would maintain those credit ratings. Another question from the web. How do you reconcile your kind words on Target's management past performance and the fact that you're running a slate to unseat incumbent directors? The answer to that is there's a big difference. There's a line in the sand between management and board. And the company has conflated management and board. And I say the board is really running this proxy contest. The most recent letter I felt was very misleading. They said, vote for Target's board and management. Look at all the things we've done for shareholders. Well, a lot of those things were done by management and not done by the board. You can be supportive of management and still put together a group of independent directors that we think is going to bring meaningful value to the company. I think everyone here, I didn't go out to find people who didn't like Target's management. I went out to find people who I thought would bring relevant expertise, and it just so happens that many of them are Target shoppers, like the business, like the brand. There's a lot to like. This company's done a lot well. That doesn't mean that it can't be optimized, and bringing some fresh perspectives is going to help. Yes?
Thanks. You showed the EBIT margins for Target relative to Walmart, and I'm curious. You go through all these different aspects of the business. None of these kind of relate specifically to the deterioration in the EBIT margins and the kind of below peer average. So I'm curious to know kind of what you think the reason for that is. Obviously, it's not related to any of these specific issues, and maybe how this slate would kind of address that.
Well, I do think that in terms of explaining the downtrend over the last several years, particularly in the last year, I mean, a lot of that has to do with traffic, right? If you've got, if all the traffic's going to Walmart, and then when mom's buying groceries and she realizes she needs some clothes for the kids, it's going to be a lot more convenient for her to just go to the clothing aisle and buy clothing for her kids there. And I think Target's missing out on the incremental sales dollar. And I think, spread over the same G&A base, you're going to have lower margins. But I'd love to get Jim's point of view.
I don't have inside access to Target's sales mix, both in a food and a non-food perspective. But if you look in the heart of the recession in the retail sector, the underperforming, based upon the economy, the underperforming categories were, I'm just off the top of my head, specialty apparel, home improvement, lawn and garden, footwear. The ones that outperformed or drew customers in were food, general merchandise, HPA, and actually electronics as well. And as I see this from 10,000 feet up, the thing that I could probably surmise is that Walmart has a greater mix of consumables than Target, and to Bill's point, it's possible that driving that additional foot traffic through there generated plus EBIT for Walmart. And again, I'm not privy to that. I'm just based on what's happening in the retail sector.
I think that the company seems to be headed in the direction of growing, its grocery business. Obviously, there's a lot of risk associated with that. It's a low margin, it's a perishable business. It's not part of the DNA of the company. This was Dayton Hudson. This was a department store retailer. This is an apparel retailer. This is a meaningful diversion for the company. I think that's why I'd feel a lot more comfortable, whatever the company decides in terms of growing that business line, having someone who's been there before. I can't imagine a better person than the person who joined Sam Walton when there were 4 superstores, prototypes. I'm curious, you went from 4 to what over the course of your being there, and what did you learn along the way?
Well, it's funny. You have to be able to put yourself in perspective, and I'll never forget this if I may. So I left Walmart Supercenters with about 143. We had 4, and Progressive Grocer says, Donald leaves Walmart Supercenter expansion likely to be halted. I just stopped them in their tracks, and so now there's 2,500 Supercenters. So clearly the model was set, and it was moving forward. But when we started with 4 to 143, as I mentioned today on Squawk Box, it's not only the experience that one can lend in coaching and counseling a team or members even at store level, but it's also the mistakes that one made in putting together from the beginning a supercenter operation, and hopefully let companies such as Target be benefactors of those learnings.
We brought Jim on as much for the mistakes he's made as what he did right. So question for Mr. Ackman and Mr. Vague. This morning, Target CFO sent a letter to American Banker magazine disputing the reported suggestion that Target will exit the credit card business. In your view, should they be in this business? Why or why not? And I actually have a copy of the letter, which you can find on the web. And I think that this is sort of a question of definition. I'm of the view, a strongly held view, that Target should stay in the credit card business. That is, a Target Visa card, and get as much of their sales on that card as possible, because it will help the company's margins. It will give them more data about their customers. It will tell them where their customers are shopping. A relatively small percentage of Target's sales are on the Target Visa cards. We'd want to see that expanded. But there's a difference between being in a business and how the business is financed and who takes the risk. I want none of the financing to be coming out of Target's pocket. I want it to be coming out of a bank, a large financial institution that has more resources than Target and has lower cost capital. I want the credit risks as much as possible to be shifted to a financial institution. But I want everything else, the marketing, the customer acquisition, the data analysis, and all those benefits to remain with Target. That's how I'd think about it, but I'd love to hear Richard's point of view.
I think Target can have its cake and eat it too.